I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major. Here to make you a smarter investor in about 5 minutes. Today, we're discussing what to do once you've hit the limit on your tax-free savings account. Namely, probably should start looking at your RRSP. We'll talk about what that stands for and everything else RRSP on today's episode. My guest today is Jim Gillies. Jim, thanks for joining me.
Thanks for the invite, Nick.
Jim, for most Canadian investors, we often say the TFSA is the first account you should max out. But once that bucket is full, the Registered Retirement Savings Plan, that's what RRSP stands for, is usually next. How should investors change their mindset and approach when moving from putting cash into the TFSA to switching over to the RRSP?
A great question that I'm going to answer to not much of a change, and also it's a massive change. So I am something of a, if you can, maximize both. If you're on the younger side, maybe favor the TFSA, but that's we were splitting hairs. I'm a fan of maximizing both. Unlike the TFSA, which is you fill it with after-tax contributions and it grows and compounds tax-free and can be withdrawn tax-free, an RSP is about deducting contributions today at your current marginal tax rate, which will presumably be higher than when you are in retirement. If it's not, good job. You pay a lot. You make a lot of money in retirement. You're paying a lot of tax. This is a good thing, folks. You get a tax refund equal to your tax refund on your contributions each year. So if your marginal rate is say 40%, all else equal, if you contribute say $10,000 to an RSP in a year, you'll get at a 40% marginal tax bracket, you'll get a $4,000 tax refund. You can also have your employer adjust your withholdings, and then it's kind of a, you never gave the government that interest-free loan for a year, so you don't really get it back. You just get more throughout the year. One of the strategies I've seen people do is you can take your refund from the RSP and use that to seed your next TFSA contribution as well, by the way. So that's interesting. RSPs limits are higher each year than the TFSA. Right now, the TFSA is $7K. RSPs are based on a percentage of your income up to an annual maximum, and that maximum is tied to inflation. So it's an 18% contribution of your salary up to, for 2026, the maximum is $33,810. So if you make over $188,000 a year, that's what your max is going to be. But it'll be 18%. And also, if you get a pension, employer pension, it'll be adjusted similarly. Contribution room can also be carried over year. So if you have $10,000 in this year, but you only use $5,000, you only contribute $5,000. If you have another $10,000 come up for you next year, you can take the $5,000 you didn't contribute this year and add it to that. So you could do 15 in the following year. My take on the RSP is strategically, you want to contribute as much as you can for as long as you can. There are worse problems to have in retirement than a giant RRSP you have to melt down, okay? For example, not having the income that you could generate, but choose your assets wisely, okay? So for example, high dividend payers in Canada, or domicile in Canada, are often eligible for the enhanced dividend tax credit. So if you own a bunch of bank stocks with big dividends and growing dividends every year, perhaps at Enbridge or pipeline companies and what have you, you're giving up some, the enhanced dividend tax credit if you're holding them in your RSP. So maybe hold those in a taxable account. You might actually end up being better. Conversely, for example, U.S. stocks, and you can hold U.S. securities in an RSP, and you can even have it held in U.S. dollars and left there. U.S. dividend payers are subject to a 15% withholding tax, even if you hold them in your TFSA. So much for the tax-free angle, right? The U.S. government is a 15% withholding tax, at least for now. But the RSP has a unique benefit. There is no 15% withholding tax on U.S. dividends, so maybe hold U.S. dividend names in the RRSP, or RRSP, sorry.
Yes, that's a great asset location tip. Often you think about asset allocation, picking which individual securities you want to buy. Another thing to think about is asset location. What type of accounts should I have those in? And if you're holding U.S. dividend paying securities, putting those in an RRSP can squeeze out a little bit of extra returns from that asset location choice. Now, so for the investor that's ready to execute their plan, invest in their RRSP today, what are some specific tactical steps or warnings that they need to keep in mind?
Sure. Well, first, know how much you can contribute, okay? You can get your contribution room from your notice of assessment, which we get mailed out every year here in Canada, or at least placed on the online version. If you have a MyCRA account, Canada Revenue Agency, if you have a MyCRA account, you should be able to go there and get that there as well, quite easily, not a problem. This is, of course, really only an issue if you're right up against your career lifetime contribution room. If you've not been contributing for 20 years, but you've been employed and you've built up $150,000 in contribution room, you're you probably don't need to worry about this too much. But if you eventually catch up and you're right up against it, don't rely on your own math. There are penalties for over contributing, so be aware of that. Second thing is every year in February, January and February, there is much marketing tied to what the so-called RRSP deadline. Okay, because you can contribute from like March of the previous year up to the end of February in this year, and you can count that, like you can contribute up to the end of February 2026, and you can use it as a contribution for 2025's taxes. I hate the RRSP deadline. I hate the idea because, by the time you hit that deadline, you probably don't have 18% of your annual salary just sitting around in cash looking for something to do. Okay. I'm very much a pay yourself first kind of guy. Figure out what's your contribution room. And if you get paid 24 times a year, 26 times a year, 52 times a year, divide that contribution room by the number of pay periods and contribute that every pay period. Pay yourself first. Third, own growthy stuff in your RSP, even if it's just low-cost index tracking ETFs. RRSPs are long-term investment vehicles that foster compounding. Let them do their job. Please do not just hold cash or, very low-yielding bonds or bond funds in there. Let the compounding work for you. And finally, can be a little controversial, Nick, but as you approach your retirement years, okay, have a meltdown plan. So you are required to convert your RRSP to a RIF, a Registered Retirement Income Fund, by the end of the year in which you turn 71, after which you have to make mandatory minimum withdrawals that increase annually as a percentage of the remaining funds each year. If you are fortunate enough to buck for early retirement, you may want to consider RIF conversion early, well before you turn 71, and pay tax on those withdrawals basically after you retire from employment. Yes, I understand that tax bill might hurt. You might feel bad. Remember, you've had years or decades of tax-free compounding before this, and then use those proceeds to continue contributing, say, to your TFSA or to taxable accounts with a long-term buy and hold bent. And again, maybe taking advantage of the enhanced dividend tax credit, or even paying off any debt you maybe carried into retirement. So there's a lot of things to think about with RSP, but remember, this is a long-term account where you can get the benefit of compounding and tax-free growth for years, if not decades.
Thanks, Jim. Hopefully a helpful primer for folks looking at how to set up their RRSP and the correct strategies as they approach retirement. But a quick reminder before we go, every person's tax situation is different. This video is for informational purposes and not intended as personalized tax advice. Please consult a qualified tax advisor with any specific questions about your tax situation. Thanks for joining us for this edition of the 5-Minute Major. If you want more stock ideas from us, click the info icon in the upper right-hand corner. Until then, hope to see you next time, and Fool on.